We're going to go ahead and pick up with our training where we left off last week with the in-home presentation. And what we were covering last week are all the different things that you want in your pre-sale folder. And one of the things that we touched on was the doing the free policy review. One of the things that we promised to you is that we wanted to get Jimmy on to really dive in and really cover how to do a proper policy review. So Jimmy, I'll just go ahead and I'll put it on this screen right here, and then I'll go ahead and flip it over to you so you can start with your material.
All right, great. Thank you, Joe.
You're welcome.
Well, okay. Well, good morning, Senior Solutions. Let me just take a moment to tell you, you want to go grab a pen and paper. You're going to want to grab something to make some notes. This presentation is going to pretty much be all audio, so you're not going to have any screenshots. So get your pad out, and we're going to get started. So the first thing is I want to cover in detail, what do you want to look for in a policy review? Okay. So the first thing is real easy. You want to look at what the face amount is. How much coverage do they have? You want to check to see their premium. And I can just tell you this, when I'm out in the field, so many people don't know what they have. They have something in mind, and it turns out to be something different. That happens like very often. So not only the face amount is off, but what they're paying is off too. Sometimes they know what they're paying, but sometimes they lose touch. So you want to check those two things. What's really important also is you really want to dig in and review the riders. And I want to take each rider that I really kind of look for. Okay, so the first one is the accidental death rider. Does this policy include accidental death? Let's just take a simple policy like a $10,000 whole life, final expense product. Maybe they bought that from a competitor. Maybe it's one of the carriers we use in our own, business. But does it have the accidental death policy? Because a lot of times they will think that they have a $20,000 policy when they only have a $10,000 with a $10,000 accidental death on top of it. You also want to check, does it have a return of premium? Okay, and we'll dig into that a little bit more often, but that is ROP for short. So if it's a term product, does it expire at the end of the term, the 10-year, 20-year, 15, whatever the term is? But does it have a return of premium option? Does that mean they're going to get all their money back? There's other products too, like universal life products that also have return of premium riders on it too. So you really want to look for that, see if it's available. If it's a term, you want to check to see when the product expires, right? There's a lot of 5-year and 10-year terms out there. The most common that I see is going to be stuff that comes in the mail, like AARP is probably the number one term product that I see out there. It is a renewable term. The rates increase every 5 years, and it renews all the way up to age 79. On the person's 80th birthday, the policy expires, it's no longer renewable, and they're no longer covered. Okay, so you want to look at that. Does it have a children's rider on there? Because a lot of times that brings a lot of value to people. So maybe they're covered for 10,000 and then you got all their grandkids covered for 5,000. How many people is on that policy is really important to know. Does it have any long-term care riders? Now, we typically don't see this in a final expense product, but you might see this in a bigger whole life product that, was put together by, let's say, a financial advisor, or maybe it's a universal life product. One of our carriers, Transamerica, offers a true long-term care rider that the client has to pay for. So you want to make sure that you're gathering all the information. The next thing you want to look for, does it have a disability income rider? If they get injured on the job, there's like really two ways that rider can go. One is going to be the income portion. So meaning that, they might get a $2,000 a month check for 12 months as an example, or they might get a waiver of premium. So if they get disabled, They don't get an income, but that means that they don't have to make their premium during that temporary disability period. So you just want to make sure you're checking all the riders. You really want to be thorough with that. Another thing you want to do is you want to look at the riders that are normally included at no extra cost, such as accelerated death benefit riders, right? So does this policy have a terminal illness rider? And if it does, at what percentage can they accelerate? So in other words, if they have a $10,000 policy and it has a terminal illness rider, don't assume that they can accelerate 100% of the death benefit, because that's how our products work. A lot of products out there max out at 50%. Does it have a nursing home rider? If they're placed in a nursing home, are they able to accelerate the death benefits? How about a chronic and critical care rider? So, if they get a chronic illness, chronic would be something that's going to require some sort of help or assistance with activities of daily living, such as eating, bathing, dressing, toileting, those type of things that usually are for long-term care. So, you want to see if they have those riders. And then the critical illness rider is if somebody's diagnosed with some sort of critical illness. It could be cancer, it could be dialysis, could be a stroke or a heart attack, and then they're able to accelerate a percentage of that death benefit. So you really want to be thorough. The way I look at this, when I go into a home and I sit down with a client and I review this, I see an image of myself as being a consultant. I see myself being the professional. I see that they're looking at me like to give them the answers. And I don't want to just look to see what's the death benefit and what's the premium, and then I'm going to try to compete. No, I want to be thorough. Maybe there are no additional riders. Maybe there's no accelerated death benefit. There's no optional riders. Well, at least I know I'm working with a bare minimum death benefit, and then I know what the monthly premium is. And then that allows me to set up my policy so I can present it and show all the benefits of what we have to offer, right? So you really want to be thorough with that. The next thing that I look for is when was the policy issued? How long has this policy been enforced? This is real important. If the policy's been enforced less than 2 years, or particularly less than 1 year, then that's a pretty simple, negotiation, as you're trying to be competitive to get them a better deal, right? But if the policy's been enforced more than 2 years, then you just got to make sure you're doing the right thing, because maybe the right thing is to leave that policy in force and add additional coverage. But we'll go over that more in detail. The next thing is guaranteed renewable. If the policy is a term policy, as an example, is it guaranteed to be renewed, or does it just expire at that time? And so what I mean by that is, let's say somebody has a 10-year policy, a term policy. If it just expires without any renewability, then that means that when 10 years down the road, they need to apply for brand new coverage all over again. They got to go through medical underwriting, the whole works, right? Plus they're 10 years older. Guaranteed renewable means that they don't have to prove insurability. The company will automatically renew their policy without any proof of insurability. So this person might have developed some sort of illness that makes them no longer insurable, but because it's guaranteed renewable, they can renew it and continue their coverage. So you want to check that. You want to check to see, is it convertible? And I'll elaborate on this more in a second too, but a convertible policy means that the initial policy is a term policy, but there's a provision in there that allows them to convert that term into a permanent policy. And depending on the carrier that wrote it, they may be able to convert all of it or a portion of it. Normally, there's a minimum amount that they have to convert. And then also it would determine what it's convertible to. Maybe it's convertible to whole life, maybe it's universal life. All right, so that's important to know. And then, does it have cash value? So it could be a whole life policy with cash value. It could be a universal life policy with cash value. It could even be a term life policy with cash value. The term life with cash value is going to be one that has an ROP on it. Okay. And then lastly, you want to look to see, are there any paid up additions, or I should say, does it have a paid up option? And so again, I'm going to elaborate more on this in detail, but when you're looking at the policy, let's say, for example, it's a whole life policy. They've had it in force for 4 years. It'll say, okay, at this point in 4 years, they're going to have this much cash value, or the option is to take a paid up insurance policy in X amount of dollars. So just to kind of give you an example, let's say it has a $1,500 cash value, or they can take a $2,500 paid in full policy. So in other words, they don't have to make any more payments, and then their policy's paid up for $2,500 as a death benefit. So you want to know that, and I'm going to get into the reason why. Okay, so the next thing is the analysis, right? The policy that they have, is it competitive, right? So let's just take a basic example, just straight up whole life versus what you have whole life now, right? There's a lot of competitors out there. I won't name names, but I'm going to say mainly debit companies. Debit companies are agents that go door to door, cold calling. When they sign up a policy, they actually collect the payment every month. That's a debit company, right? So that agent's coming around every month to collect the payment. There's like a little ledger that they fill out, right? Those companies, typically their rates are kind of high. I've gone in and done a comparison with a debit company with a policy that was 4 years old, and I was still able to beat their price like by $15 a month, right? So I'm just saying that, sometimes you get an easy layup like that. Another thing that you want to do is check, is the coverage what they have, what they thought it was. So I mentioned that in the beginning. A lot of times people don't know what they have, and I'll give you some examples. So my first example is, and these are real stories, right? One customer thought that her policy was paid in full. And she says, I have a policy that's paid up, Jimmy. How much is it? It's for $20,000. Great. I reviewed the policy. It was a term policy that had expired the previous year. So I asked her, because I thought maybe I was missing something, why do you think this policy is paid up? Well, because they stopped drafting payments out of my bank account. Okay, let's get clarification. Let's call the insurance company. So we called the company, had them on speakerphone. She gave them the policy number. And lo and behold, they confirmed what I was fearing, was that her policy had indeed expired, and there was no more possibility for additional coverage with that carrier. So here's a lady that thought her policy was paid in full, and in fact, it was canceled, right? So you want to be thorough. You want to check that. Here's another example. The customer thought that they had a $100,000 whole life policy, and their payment was only $36 a month. Now, these people were in their 60s, okay? And I was thinking, man, they must have got that when they were really young. So then I was like, how old were you when you got it? Oh, it was like 6 or 7 years ago, maybe 8 years ago. Really? Let's take a look at the policy. I mean, because it just wasn't adding up in my head. We get the policy, and the guy kept telling me, I know it's a whole life. It says right on the front, whole life. I have $100,000. Lo and behold, it said whole life, Joe. And I think you've heard me tell this story. It was for $5,000, but it had a $95,000 term rider on it. And the rider was only good for 10 years. Okay, so yes, he was covered for 100,000, but only 5 was whole life. That extra $95,000 that he had as a rider was about to expire, right? So guys, a lot of times these people either they they don't remember because it was such a long time ago, or maybe the agent wasn't clear with them or didn't explain it thoroughly, or maybe straight up the agent was dishonest or misrepresented something, right? So it's our job to make sure that as consultants, we're really reviewing the policy and explaining and showing them in their own policy what the contract says. Here's another example. The customer purchased a permanent policy, right? Which was a universal life, or I've had IUL's indexed universal life and thought it was a whole life, right? Because the agent says a permanent policy. But here's the difference. The agent quoted them and set up the policy to pay the minimum payment due. So I just want to school you guys real quick here. So when you do a universal life or index universal life product, there's something called the target premium. And that target premium is going to keep the policy in force basically to age 100. Okay. So that's why they call it a permanent policy. There's also a max premium amount. That means that they can pay more than their target premium, and it will either build cash value or go beyond age 100. Okay. And then there's this other thing called a minimum premium. And when you set up the policy at the minimum premium, it typically will lapse about year 15. And this does vary by customer, okay? But if they're paying the minimum premium, it's not going to be permanent. It's not going to last them their whole life. Depending how they were when they purchased it, that policy could lapse, or they might need to, increase their payments dramatically. It might be 200 or 300% of what they were already paying. So guys, those are the things that you want to look for out there. Example number 4, customer combined the accidental death with the natural death benefit, thinking they had a total of 20,000 when in fact they only had 10,000. I see this all the time, right? So you just really need to elaborate on, this is the natural death benefit. And you only get the other 10 if you died in an accident. So I always joke with them. So make sure you die in a car accident, okay? And they usually laugh, So I mean, that's, again, you're needing to educate the customers. And then I'll give you another example. Number 5, customer had an accidental death benefit policy, not a life insurance policy. So I see this from time to time. Maybe they purchased $100,000 or a $50,000 policy, and the payment seems unreasonably low. It's probably accidental death only. It's the same scenario. They gotta die by accident or it doesn't pay. Also, when clients tell you, oh, I have some coverage at the bank, I have some coverage at my credit union, that coverage is an accidental death policy. That's not life insurance. Banks are not insured, so they offer accidental death benefit. That's a different type of license, right? So just to let you know, originally they're not insured. They're not licensed to sell life insurance, but you can get a different type of license, what they call a limited lines, that allows you to sell accidental death, right? So that's what they offer at the banks, right? I want to go back and revisit on term real quick. A lot of times, I don't know if I have an example here in a second for strategy, but a lot of times I come across people that they have a policy with one particular carrier. I don't think I should use their name, Joe. Should I or no?
What are the initials?
P and A.
Oh, yeah, why not?
Okay, so when you see Primerica out there, it's really one word, right? But Primerica does not sell whole life or universal life. They only sell term products. And they're kind of sneaky about it. And in many cases, I don't know if it's their training or the agents just, are uneducated, or maybe they just simply misrepresent the product that they sell. But it's a common thing that I see when I come across this policy. The people say, no, it's a term life policy, but it covers me up to age 99, which that sounds good up front. But once you dig into the policy, typically it happens sometime in their 60s when the policy is guaranteed renewable. It renews year to year. And in the policy itself, it'll tell you what those premiums will go up to. I've seen this a lot of times. I had one just recently when she turns 53, which is next year, her policy expires. And she's going to go from paying like $86 a month to paying $160 a month, almost double. And then the year after that, it goes up to over 200. And then the year after that, it goes up over 300. And within, I'm going to say 10 years, the premium goes up to over $1,000 a month. So if you, and that's, she's still fairly young, she will never make it up into the 80s or even 90s. It would just not be cost effective. Who can afford a $2,000 or $3,000 a month premium? It's just not going to work, right? So you got to educate your people, and you got to point that out in their policy, right? So, okay, so now let's talk about strategy. Let's put all this together. So I told you what to look for. Joe, before I move on, I don't know if there's anything I might have missed or you want to add.
No, because no, this is really good, man. I guess the only thing I will just ask, and then just let me know if you're going to cover it. There's another company out there that I think that kind of uses some deceptive practices, and their initials are L like Larry, H like Henry. You going to cover that at all?
I wasn't planning to, but I'll let you. You're talking about like with what everything's included. They say, oh, this is included.
Well,
Guys.
that, and then also you mentioned it with other policies, but guys, I see a lot of people that like Lincoln Heritage is obviously a big competitor, and it just seems, I don't know if they're trained to do this, but I mean, I've done a ton of reviews where people think they have $25,000 or $30,000 of whole life, and it's like that example, the guy that you had the 5,000 whole life, but a $95,000 rider on it. I see a lot of Lincoln Heritage policies that have very small, sometimes only 3,000 a whole life, and then like a $25,000 accidental attached to it. And the people think they're have whole life for the whole thing because the way it's presented. And Mrs. Jones, your total coverage is this. Not to mention that these people think that this company is going to negotiate and somehow magically get them a full burial, everything included for $5,000. Guys, a $5,000 policy is a $5,000 policy. It only goes so far, okay? It's not going to cover a full traditional burial regardless of what the agent said. The other policies that I run in quite a bit that does a lot of mailing are the Globe Life policies, which are almost always term. I don't know if do you run into Globe very often?
Occasionally I do. I mean, Globe and AARP are like almost identical programs.
They are. The Globe's not horrible though. I mean, the ones
Right.
I've seen with Globe, as I think theirs at least is good until I think it's 90 or 95, and the premiums do go up, but they're not. I mean, they're not crazy out of line, I don't guess, but we do come across Globe policies, and then the which are typical. If the people were usually either replacing them or adding on to them. The other thing I just wanted to find out, Jimmy, is that will you kind of cover the scenarios of like when should you replace a policy?
Yes, I'm going to cover all that.
All right, and then one other thing too is when do you help a client decide, is it better to take the cash value and do a reduced paid up, or when is it better for the client just to take the cash? Let's say they've got 1,000, 1,500 or whatever, and take the cash and keep it. And those are really my only questions.
Okay. Well, we're gonna cover that now. Before we cover
I
that,
figured you would.
I want to go back and we're just going to do a brief review because there might be some new agents on here. And I just want to talk about these are the policies that are available to people. So you want to identify, is it a term policy? Term policies are temporary. That means that they expire, right? So it could be a 5-year term, a 10, 15, 20-year, maybe even a 30-year term, or it could be a term that expires at a certain age. So not so much like how many years, but when they reach a certain age. That's a term policy, okay? It could be a whole life policy. Whole life policies are exactly that. They last the whole life. They will never expire as long as the person continues to make their premiums, okay? Then you have a UL, which is a universal life. Now, that could be worded different, right? Depending on when the policy was written and depending on the carrier, it might say adjustable life or flexible life. It's all the same thing. The way a universal life policy works is that there is flexibility. The client can make the premium that they want. That's why there's a minimum, a target, and a maximum, right? So you got to see how it was structured by the agent. Then you have an IUL, which is basically an indexed universal life. The big difference here is that the universal life pays a fixed interest rate on the cash value, and an index uses an index. 9 times out of 10, it's going to be the S&P 500, but it might be a different index. And it's going to use that index to credit the account with interest. If it is an indexed universal life, you want to look at it to see, you know, which index is it using. You want to look at the cap rates. You want to look at the participation rates, and you want to see mainly, is the policy performing well, right? Then you have a VUL, which stands for variable universal life. A variable product requires that the individual be securities licensed because the money is invested in the stock market. It could be, or I should say, an equity. It could be a bond, or not really a bond. It could be a mutual fund, or it could be an individual stock, or it could be a portfolio of stocks. But as you know, the stock market has its ups and downs. So even though it's illustrated to last to a certain age, if the market's not performing well, their policy could lapse because there's no money in it, right? So you want to identify what is it. And then lastly, it could be group coverage, right? So group coverage is a policy that you get through your employer. Now, here's the thing about group coverage. A lot of people, this is the main reason why final expense agents have a market to sell to, is because most of the people that we go out and see, they had insurance through their employer. They had a $50,000, $100,000 policy, maybe $150,000 policy while they were working. And then when they were separated from employment or retired, they were not aware that they weren't able to keep that policy. And that is right. Retirees leave the group. They're no longer part of the group. So some employers have a retiree benefit package, but that life insurance changes. They may get a free life insurance for a small amount, like 5,000, 6,000, 10,000, and it's paid up and they don't have to pay for it. Or they may have an option to pay for their cost of insurance. You know, it might be a $10,000 or $20,000 policy, but they got to pay for it. If they work for the government, most of the time I see that the policies are decreasing benefits. So like I see a lot of, particularly here in Texas, a lot of retirees from the state of Texas have a death benefit that starts off at 40,000. And as they age, the death benefit decreases, right? So what is it worth the day that you're there with the customer? Usually it's like 12,000 or 8,000 because it's decreased so much. That's why they filled out the card, because they know that their insurance is decreasing in value, right? So you want to know all of that stuff, okay? Here's what I have to say about the policy. If you don't understand it, ask the customer if you can take it with you back to the office, and then scan it and email it to Joe or myself and let us review it, let us analyze it. We'll give you the breakdown, and then you can go back out there and talk to them and speak to the product specifically, but also intelligently and be able to explain it to them. So those are the different types of insurance. So the next thing I want to say is always be ethical. Always disclose what you're doing and what the strategy is, and do what's right for your client. Don't do what's right for your pocketbook, right? If you keep your customer's best interest at heart and you explain to them exactly the strategy that you're doing, you're going to be successful, because more than likely they're going to, if it's increasing their benefits, if it's increasing value or decreasing their cost, they're going to move forward with it. So you don't need to be, scandalous. Do it right. Be ethical, right? So having said that, let's talk about some specific scenarios. So the first one that I have listed says, always look to improve the situation. Can you give them a better rate? Can you give them higher coverage, or can you give them more benefits? That's the first thing. Those are the simple ones you want to look for. The second thing you can do is you can look and use a GULE, which we're talking about, Mutual of Omaha Guaranteed Universal Life Express, to get them a more competitive rate. So let me give you an example. A customer has a $10,000 policy. It's less than 2 years old, and they want a total of 20,000. So they say, Jimmy, I have 10,000. I want to add 10. I want 20,000, right? So you go back in and you look. When they bought the policy at age 59, their premium, this is a 60-year-old male, non-tobacco, their premium was $40.82. Because he's a year older, another 10,000 is going to be $42.76. That puts their total cost at $85.58, right? But to be strategic, you can quote them a GULE. Now, of course, they got to be healthy, right? Healthier than the living promise. But GULE, the minimum face amount is 25. But I can quote them a $25,000 death benefit for $82.05 a month. So that gives them more coverage and a little bit less. So can you see the value in that? So what do you think about that, Joe?
I love that strategy. And then when you did the quote, is that the GULE? We're not going to get into the product, but how long is that product guaranteed for?
Age 100.
That was 100. Okay, perfect.
And then let me give you another scenario, or another strategy is, let's say you go up against a pre-need funeral plan. I do this all the time. You review their policies, right? Do you know that a prepaid funeral plan is a life insurance policy? And let me just elaborate briefly. I won't get into a whole lot of detail, but the way they work is they go to a funeral home, they meet with the funeral director, which is a licensed insurance agent, okay? And then they say, okay, what do you want? Here's our package. It's pre-need. In this particular example, the lady wanted a $15,000 funeral package. So they locked her in. It sounds really good. Look, you're going to get this casket, you're going to get these flowers, you're going to get this blanket, and you're going to get this and that. And so $15,000, we're going to give you all this stuff for 15 grand, and we're going to lock you in at this price. And no matter how long you live, there's going to be no inflation. You're locked in, and you're going to pay this off in 7 years. Okay, great. Well, this particular lady was 55 years old, and her payment was $185. Okay, locked in. She thought she got a really good deal. All right. Now, here's the truth of the matter, is that it's a life insurance policy. That's what they call a 7-pay. It's whole life paid up in 7 years. And what it does, it has a built-in 3% death benefit increase. So every year the death benefit increases by 3%. So what happens in 20 years, that policy is worth $30,000 to the funeral home. The beneficiary is the funeral home, right? So it doesn't matter when she dies, the prices are more or less in line with today's cost, so the funeral home makes money. That's how they do it, right? It's not that they're paying down a plan. It's not like really like a debt, you know what I'm saying? It's a life insurance policy, okay? So this is what I told her. Look, that $15,000, that when you die, that death benefit goes to the funeral home. And rightly so, because they're providing all the arrangements for you. But what if I can show you a plan that the money would go to your daughter, right? And whatever money is left over, then she's able to keep for herself, and I can save you some money, right? So this is what I proposed to her, right? Transamerica has a 10-pay preferred. I quoted her $30,000 on a 10-pay, and her payment was $167.90. Okay, almost a $20 a month savings. And mind you, if she died prematurely, let's say she died within the first 10 years, the cost is still going to be about $15,000 or less, because now it's not a preemie. Now she got money in the bank. The daughter can negotiate with the funeral home, right? But whatever's left over goes to her daughter. See, her daughter's the beneficiary, not the funeral home. Do you think in 20 years from now she can get a burial for 30 grand? Heck yeah, right? So Joe, doesn't that make sense?
Absolutely. Sign me up, brother.
Right? Now, here's another beautiful option. If they're in really good health, right? Liberty Bankers Life has a Flex for Life product, right? So it's not final expense, but you can go Flex for Life, 30,000, the same 30,000 on a 10-pay. Guess how much the premium is, Joe? $133.97. So now I'm really bringing value. I'm saving her $50 a month, and I'm doubling her death benefit. So do you see the value in that? That's a no-brainer. All right, let's talk about using the paid up option on an existing policy, right? So this is an actual case study as well. I'll just call him Mr. Smith. Mr. Smith was an Uber driver, Joe. He gave me a ride to the dealership one Friday morning so I can drop off my car for maintenance.
Okay.
We talked briefly, gave him my card. He called me later that day, wanted to schedule an appointment. He had a $10,000 policy whole life with one of our carriers that we use, and he wanted some additional coverage. He wanted a $10,000 additional coverage, so he wanted a total of $20,000, right? He was paying $46 a month on his whole life policy that he had purchased when he was younger. So the new cost for additional $10,000 would be $58 a month. So that put his total payment at $102. He did not like crossing that century mark, Joe. It was like, oh man, $100. It's not really what I want. So looking at his cash value and looking at his paid up coverage. So looking at the policy, if he were to go ahead and take the paid up option, he would have $3,500 in paid in full whole life, and he don't have to make any more payments, right? So this is what I offered him. I said, look, let me give you a quote for $16,500. That was $89 a month. You convert this whole life to a paid up for $3,500. That gives you the total 20 that you want, and you're at $89 a month instead of 102. He loved it. Boom, we're in. I've done this several times, and in some cases people say, well, what if I keep the cash value because I need that money right now? Sometimes I get the whole thing, right? But that was their call, not mine. So I don't know if you want, I know Joe loves this strategy. I don't know if you wanted to expand on that, Joe.
On the strategy you just talked about?
Yeah.
No, I mean, I just think it's brilliant. And I mean, here's the thing. I never recommend to a client that they keep the cash. I just let it, like you, I let it be their idea.
Yep.
You know, like this, you know, I always go for the paid up edition. And a lot of times, guys, it's in their policy. I mean, it'll show all whole life policies. If they have that built in, there is a schedule. And what you can do is you can simply call the carrier, and based on how many premium payments they made, they can get a quote for exactly what the paid up edition, paid up insurance would be. The other thing too is is when in doubt, I mean, number one is the only way you're going to get good at doing policy reviews is to do them. And don't be embarrassed to call the carrier. Call the carrier and ask the questions. That's how Jimmy and I got good at doing policy reviews, because we've done a lot of them. And I mean, once you've seen, you know, the Primerica policies and Lincoln Heritage and all these other carriers, then and you've asked all the questions, then you know exactly where to go. You know where to go to the declaration page to see what the deal is, or go to the you know, where the increase of premiums are going to be. So just get in the habit of doing policy reviews. Be the professional in the situation. So I'll turn it back over to you, Jimmy. You're doing an awesome job, man.
All right, thank you, Joe. So
Yes.
let's talk about the next strategy. So the next one is going to be using Term Life Express with an ROP, return of premium rider. Okay, now this is only going to work for people under the age of 50. Okay, because it's not offered if you're 51 or older, right? So if they're under 50, I'm going to give you another case scenario. 45-year-old male, he tells me he wants $50,000 of coverage, right? Well, guess what? I quoted him. Well, first off, you know, if you don't know already, Mutual of Omaha on Living Promise only goes up to 40,000, right? But Transamerica goes to 50. So I quoted him 50,000 whole life, 120, 150 a month. Okay, little too pricey for him. Term Life Express with the return of premium. This is how it worked. His quote on a 20-year was $78.25 a month. Okay, so that means he's covered for $50,000 for 20 years up to the age of 65. Now, this is the way you present it. He either has the option at age 65 of getting all his money back, $18,780. That's his return of premium. Or he can opt to take a reduced paid up policy, and the reduced paid up policy is for $39,686, right? Let's just call it 39. So he's covered for 50 for 20 years. Then he don't have to make any more payments, and now he's covered for 39,000 up to the age of 99. That's a beautiful thing. If you want to get lower on the premium, you can go with a 30-year ROP. So that means that same 50,000, he's covered for 30 years up to age 75. His premium is only $59.07 a month. And that's like half of what his whole life rate was, right? His return of premium is 21,000 and change, and his paid up option is 33,799. So, you know, at age 75, he doesn't have to make any more payments. He can convert that to a paid up policy, and he's covered still for 33,799. That is a great alternative. So guys, you don't have to be doing a policy review to use this strategy, but sometimes I use this strategy to compare it to whatever they currently have. So that's another great option. Joe, I don't know if you want to expand on that or you want me to move on.
No, just move on, man.
All right, this is the last and final scenario that I have for you. This one might take a little time. This is a good one. You know, when you're dealing with people, a lot of times people ask me this question, Jimmy, what's the best solution? You know, is it term? Should I go whole life, universal life? And you know what my answer is that there's no cookie cutter answer, because it depends on your age, it depends on your health, it depends on your goals and your objectives and what you're trying to protect, right? So there's not one answer that's good for everybody. You just really have to dig down. So a lot of times, oh, that's my phone. Like, what is that noise? A lot of times, I recommend a blend of doing a combination of whole life and term. But I want to give you a scenario with one of our carriers, which is Foresters Financial. they have a very unique product called Advantage Plus, right? It's a whole life product, and it does offer the term rider. But the other thing about the Advantage Plus is it's what they call a participating whole life product. That means that at the end of the year, instead of them giving dividends to their corporate shareholders, they give the dividends to their policyholders, because Foresters Financial is owned by the policyholders, not by a corporation. Okay, so those dividends are converted to paid up options, so their death benefit increases over time. Right, so just know that it has an increasing death benefit. Right, but I'm going to go back to this term rider, because I previously gave you a couple illustrations where I thought that the agent did it in a, I'm going to say, in a misrepresentative kind of way. He did it in a very sneaky way. The customer wasn't informed, didn't know it. But let's do this in a way that makes sense. So I'm going to give you two scenarios, right? Let's use a young person, 35-year-old male. He's got some children. He has a wife. You know, he's got a roof over his head. You know, he's got a mortgage. And you know, maybe he can't afford a real high expensive permanent policy, but he needs some protection. So I'm going to give you a really good example of how you can do this the right way. So this 35-year-old male wants $250,000 of total coverage. You can do a $50,000 whole life, and you can either do a 10-year or a 20-year term for $200,000. I want you to follow with me on the numbers here. So let's go with the 20-year first, which is the higher premium. He's got total 250,000 coverage. The premium would be $102.64 a month. So for $102, he's covered for 250,000 for 20 years. When he turns 55, his kids are out of the house. His house is paid for. He doesn't need that much coverage. Basically, at that point, he's just really looking for a death benefit to cover his funeral costs and maybe leave some other money, right? Well, at that point, his $50,000 whole life death benefit grows to $62,000. So now he's really insured at $62,000. Because the term falls off, his premium drops. So he drops to $64.14 a month. That's a pretty good option. So that means that, you know, while he's making money and earning, you know, he's at work, he can afford the 102. But when he's getting ready to retire, he can cut his expenses in half and go down to $64 a month and still have a $62,000 policy that continues to grow. Okay, that same individual on a 10-year term, his payment would be $93.72 for the 250, but it expires in 10 years. At that point, oh, I'm sorry, I gave you the 62,000 was for the 10-year. Oh, no, that's right. The 62,000 is right. After 10 years worth 62,000, but let's say he continues to live to age 75. Do you know, Joe, that 62,000 grows to 90,000, his whole life death benefit?
Yeah, I knew it grew pretty good. I didn't know it was going to be that high, but
yeah, so it grows to 90,000. That's a beautiful thing. Now let's take this another route. Let's take a senior, let's say age 60, female, right? Maybe she has some debt. Maybe she still owes on the house. I get this quite a bit. People tell me, look, you know, I owe, you know, X amount on my house. And if I pass away before I pay it off, I just want to make sure that, you know, it'll be paid off so that my daughter or my son, whoever I'm going to leave it to, don't have to make the payment. Okay, great. You can do a $25,000 whole life with a $75,000 term, okay, for 10 years. So remember, this is a 60-year-old lady. She has a total coverage of 100,000. Okay, her payment is only $119.26 for 100,000. Man, that's a good deal, Joe.
Yeah.
When the 10 years expires, her payment drops to $82.18. Okay, but her whole life value at the end of 10 years is 28,000. And at the end of 20 years, when she's 80, her whole life value is 35,000, and it continues to grow. So that's another really big scenario. So guys, I mean, that's a great example. I got a bonus example for you, right? So I want to go back to something I said in the very beginning. You want to look to see if they have a convertible policy. I'm just doing this right now, as a matter of fact, with a client. I'll give you this scenario. This particular customer purchased a 10-year term at a preferred plus rate 7 years ago, and it was with one of our carriers. I won't name them, but they had a really good rate. They were covered for $250,000, Joe, for only like $46 a month. The customer today is 64, not 54, right? His policy is about to expire, but guess what? His medical has changed. He's no longer preferred. He has heart issues. As a matter of fact, he's not insurable. So his option is either to not have any coverage or go with a guaranteed issue. Okay. If he goes with a guaranteed issue, he's going to go from a $250,000 death benefit to $30,000, and the payment I think is going to be like $100 and something a month. It didn't make sense to him, right? But because the policy is convertible to permanent, right? I was able to find out what class he was at, which was preferred plus. The minimum he can convert is 100,000. The max is the full 250 that he's insured for now. So he can take the 100,000 minimum, which is what he's going to go with, convert that to a permanent policy. It's going to be a universal life with a fixed rate, and it's going to be guaranteed to age 100, and his payment is going to be $202 a month.
Wow, that's an awesome deal for someone who is essentially uninsurable.
Exactly. And not only, is he getting a good deal on that, but I mean, I think what's really happening is I don't know how much time he has left. You know what I'm saying? So that really, even though it's going to be a little bit of I'm going to say expense, or it's going to, stretch their budget a little bit, because he's going from $46 to $202 a month.
Yeah.
They have coverage. So, when he does pass away, they're going to have at least $100,000 death benefit. So can you see the value in that? I mean, here's a guy.
Plus two, Jimmy, no contestability period.
Exactly. No contestability period.
Yeah.
There's no, he's already, it's got guaranteed renewable evidence without evidence of insurability. So that is, that's the sweet thing. You know what? For me, it's not so much about the premium, but I think most guys would love to write a $202 a month premium.
Yeah, agreed.
It's about being the hero. I really am the hero for this family. They just they love it. They think that I'm the greatest thing. They've been shopping around. They can't get approved with anybody. As a matter of fact, this deal was a referral to me from another agent that couldn't get them done. But
sweet.
So guys, those are the things that you want to look for. I want to remind you again, always be ethical, do the right thing. You want to improve the customer's situation, whether it be lowering their cost, adding value, adding benefits. One thing I didn't touch on was, sometimes you're going up against a company that has no living benefits. Maybe it's just a straight up whole life, that there are no, terminal illness riders or nursing home riders, nothing. And sometimes you can offer them something that's going to give them those additional benefits at the same, or sometimes a lower value or lower cost, but you have more value because you have these extra benefits. So really dive in, dissect what they have, come up with a really good strategy. You know, if they have a complicated policy, there's nothing wrong with getting back to them and doing a second appointment. They're going to appreciate it better. You're going to be able to make a better recommendation for them, probably get a higher premium, and you're going to be the hero. So Joe, that's my how to do a policy review, and I'll turn it back over to you.
All right, buddy. Very thorough, man. Nice job, Jimmy. Awesome, man. That was more than I bargained for. That was really good. I'm glad we got this recorded so people can check it out on the replay. Guys, with that, man, we're gonna wrap it up. We'll get back to you next weekend or next Friday for for another edition of sales training. So God bless everybody. Have a great weekend. Thanks a lot, Jimmy. I appreciate you doing such an amazing job.
Well, thank you, Joe. Hey, good
All right.
selling, guys. We'll see you next week.
All right, man. Take care. Bye-bye.